Hi traders, it's Chris. Hope you're having a wonderful day. As promised in the VIP members room, I thought I'd do some quick coaching sessions on price action to help you get better performance and to become more successful in the long term. The subjects we're talking about today are pivots, liquidity zones, trend lines, support resistance lines, breaker structure, change of character, stop losses and targets. So we're going to go through quite a lot in a short time frame. And of course, now with price action, you've got very little to go on. Now, however, the most important ones are, of course, is the trend. That is the most important one. And trend lines, support lines, demand areas, supply areas, breaker structure are all part of that. So I'm going to go through this chart. This is the US yen and it's the record highs. So we can see what's happening and what's actually going to happen next. I'm going to dial into the charts. I'm going to go down to the daily, to the 4 hour, and include some of the tools that we use for the price action charts. Now, if you've got the price action charts, congratulations. You're now on the start to your trading career. And I'll also go into intraday setups for you to get to know. And of course, I've been through this before many times, but nonetheless, for those who are new to price action, it's a lot of fun, actually, and a lot of people are enjoying it. So this is the US yen on the weekly chart. I don't really need to say much about this because the tools that we have tell us. So the important areas are demand areas, and of course convergence. I talk about that quite a lot. And as the price comes down into a trend line and hits an important demand area, liquidity area, which is blue, and basically what's happening here is all the institutions, all the buyers are getting set up, the big dogs are getting set up to buy into these areas. They have these orders and there's a nice reaction there. So remember that it doesn't matter what the time frame is. The situation is that whatever time frame you want to work on, you can work on. And top-down analysis is the key to your success. So understanding where the breaker structure is key. So let's draw a line there. We can say that, yes, there's breaker structure here to the upside. And we can say that there's convergence down here. Now, because it's a weekly chart, you're not going to be waiting for the price to come back down to 150.57. That's 700 pips. That doesn't make any sense. But what you can do is say right away that the price is in an uptrend. You can see that. We have some important areas of information. Dialing down to the daily, getting closer to the market, we can see the breaker structure here. Much, much clearer, isn't it? And I've also got the 100 moving average here, which is just a key to telling me that the price is upwards. Look how the price, the moving average is moving. Even before it's moved, it tells you that the price is up. So you don't need much else to say that. So the daily chart, yes, we can say that we've got breaker structure to the upside. Have we got an uptrend? Yes, we have. Have we got a nice correction here? Yes, we have. Back into the liquidity zone, and therefore you have a buying opportunity. Now, one of the questions is, well, can we use the Heikin Ashi charts to enter? Yes, you can. So the Heikin Ashi charts, let me show you the chart without the Heikin Ashi charts. And as you can see, they're not as clear for me in terms of buying and selling. They're just not quite there. And remember, once you've got into the Heikin Ashi charts, you're removing all the noise or most of the noise in the market, which we're not interested in. Okay, so into the daily, we can see that the price has been moving up into liquidity above the 100 moving average, which is acting as support, as well as telling you that the price is going up. Okay, price is going up. So it's on an upward slope, if you like. Down to the 4 hour. Now, of course, the closer you get to the market, we're not going to go down to the 5 minute, certainly not at this stage. Once you've done your analysis and you want an intraday trade, then that would make more sense. So this is the 4-hour chart. And as we can see, we know it's in an uptrend. We can see this clearly by this moving average and the trend line here as well, the green line. So you can actually see the points at where you would be interested in buying. Now, in the last few days, there's been some intervention in the markets in the yen. And as you can see, high volatility during the Asian session. So it's best not to trade these particular pairs during the Asian session, especially when there's intervention, of course, because they're just going to take all the stops out of the market. So we can see clearly that the same tools that we're using, POI here, POI here, POI here, which is basically a reversal and a continuation into the demand area, liquidity, 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 above the 100 moving average, into an uptrend convergence, we can say, and now heading up into a supply area here, which it got rejected at 160. Now, one of the great ways to spot an uptrend and a continuation of uptrend is to use the pivots on a 4-hour chart, but you can work on any chart if you like. But instantly you can see that this is a stepping stone effect, as I call it. So a stepping stone effect in an uptrend simply means that the average price for the previous day is moving up. So you can see these positions here, here, stepping stone, stepping stone, stepping stone. And once you get a change of character at any stage, change of character simply means that you could possibly see a reversal, then the average of the pivots moves down. Once you see it break into the upside again and the average of the previous price starts to move up, you have another set of stepping stones, i.e. support areas where you can trade into. So as long as the price is achieving higher highs in terms of the central pivot, the average price for the previous day, then you can say that the price is continuing and you've got a very, very strong chance of actually the price going up. So price action tools are really fascinating and highly successful, and especially for intraday trades, if that's the kind of thing you want to do. Now, as we can see here, we've got a set of pivots no longer achieving higher highs, and so therefore the price is now thinking about where it wants to go next, probably down to this demand area here. But as we can see, it could quite easily in the next few days start to achieve higher highs, but you don't want to be entering into this position while it's doing this. Better to wait for the next 24 hours when you may get a pivot there, a pivot there, a pivot there, and so on, up to this area of 160, which is our target for the long term anyway. So let's go on to calculating targets based upon breaker structure, shall we? So based upon the uptrend being moving up, in this instance on the US yen, we can safely say that the stepping stone effect is continuing, and therefore you could easily have a pullback into the buy zone, if you like, into this liquidity area here, here, and here. And then you can do a break of structure analysis. So let's have a look at that. So in this case here, the price moves down to the central pivot into this liquidity zone, and then you've got this swing higher here. I use the whole body of the candle rather than the whole wick initially, and so that's my breaker structure. Let me widen it out for you so you can see that a bit easier. Let's change the color from green. What color should we go with? Purple maybe. So there you go. So once we know that number, in this case it's 153.27, we can safely say that any price that breaks above that break of structure here is likely to go much higher. So what we do in order to calculate the target, grab your trend-based fib extension and just grab it from the previous low. You could take it down to here, which is reasonable, and then take it to the top of the highest wick, which is here. Drag it across a little bit, and it will give you the target to go by. So let's get the breakout. So for me, the breakout is just above the breaker structure number, not on it, because just to give it a bit of wiggle room, and we would have a swing low of the previous low. Swing low of the previous low below the support level, below liquidity. Now you can obviously buy, if you see liquidity coming in onto a central pivot, you can simply buy it. That's fine, but the price would not have re-established itself yet, and it could simply start just to move down before it re-establishes itself. So just be aware of that. So breaker structure is a bit better way to trade, a bit safer way to trade. It's set and go, which means basically you're going to put in a pending order, and then you're going to set your stop, and then you're going to set your target. So in this instance, what we are looking for is 2 to 1. So 2 to 1 is there, and that's 0.786. Now my preference is to use the Fibonacci 618. That's my preference, and that is 1.46. So that's not quite enough for me in terms of a decent trade. All right, it's 119 pips, which is fine, but the risk to reward isn't sufficient enough for me. So there's two things you can do. You can actually take it to 2 to 1, which is there for 165 pips, or you can go 1.46 to the 618. Now the other way to do it is to recalculate your Fibonacci, because this is in a strong trend, and we can take our tool and then we can take it from the real bottom of this up to the highest wick, and then we can drag it wider, and that gives you a better, that gives you your 2 to 1 there. Okay, so just play around with the target analysis with the Fibonacci extensions, because this might not be enough to give you 2 to 1, but the previous low may be enough to give you a decent target and a 2 to 1 risk to reward. So that would have been perfect. You would have had to wait, because it's a 4-hour chart. If you're trading off a 4-hour chart, you're going to have to wait for the target to be reached, because you're going to have much wider stops and much bigger targets. So 164 pips target, excuse me, as opposed to 81 pip stop. Do not be tempted to narrow your stop into this area here, because although the price continued and the liquidity took the price higher, you are in danger of the price going sideways and then coming back down, stopping you out, and then coming back in again, and then you wish you'd had a wider stop. Okay, so again, experience tells you that, and so on. So your stops are really important. Put them in a place where it's going to make sure that you're successful. It doesn't matter how many pips there is in terms of stop. It's all about your money management rules, depending on what size of account you're doing with your demo account. But 2 or 3% of your account is fine, and emotionally you can deal with it a lot better if you are risking far less than you think you might want to, if that makes any sense. Now, in terms of target, don't get greedy. At the end of the day, yes, it went up to the full fib extension, but there are going to be lots of opportunities to come into the market as time goes on. So let's do another one, shall we? And I'll do something on another pair as well, just to give you a flavor. So here we know that the price broke out here. We know we've got the stepping stone effect here on terms of the central pivot from the previous day, the average price of the previous day. And we can work out that because it's so tight in during that day there, we can take the breaker structure to the top of the wick, which is reasonable, and we can see that the price has come into liquidity, still achieving higher highs on the pivot, and therefore we can go just above there. Now this one is of course a little bit wider, 40 pips, and let's calculate our target. Again, it takes practice, and we can see the swing low here. So drag that up to there, drag it up to there, highest point, and you can see your 618%, which is 1.9. It's close enough, isn't it? But that's a nice 78 pip target there. And of course, then you would have reached target quite quickly there before the Asian session, where you had a lot of liquidity coming into the market due to intervention. So a fantastic way to analyze the markets during the weekly. Weekly, you can see the trend and the breaker structure. Daily, continuation of the uptrend above the breaker structure, and then down into the 4 hour. You can keep going, of course. Lastly, I'd like to talk about intraday trading, which is a lot of fun. If you haven't done it before, then there's some great tools that we use in terms of discovering the best ones to choose. So the first thing to do is go into tradingmentors.com and then click on what's trending today. And once you get to there, you'll get refreshed and you'll have basically which is buying, which is selling. I'm not particularly interested in this unless I've got a strong buy, because that indicates that there's more volume in that particular pair than anything else. I'm looking for strong buys or strong sells. And if I don't have any strong buys or strong sells, I won't be intraday trading. So that's the first one. That's step one. Make sure you've got a strong buy in terms of volume and trend. Now, once you have that, we can go to our 5-minute chart, and if the website says strong buy on the US yen as an example, then we are looking for the rules to apply in the same as the weekly, same as the daily, same as the 4 hour. But because it's closer to the market in the 5-minute chart, we can see much closer, and we know our stop's going to be much tighter, and the target's going to be 2 to 1 at least. Okay, so the rules are straightforward and simple in that we have to have a strong trend. We have to have the central pivot. You can see it here. This black line here is your central pivot. We can see the liquidity zone. Okay, and therefore what you're looking for is the red Heikin-Ashi candle, because that's the correction. That's what you're looking for. And you're looking for the price to come outside the Bollinger Band, as you see here. That's not your buying opportunity, unless you want to be super aggressive. But then you're looking for break of structure to the upside. So the way I look at this is I'm looking for the whole of the body of the candle there. And I'm looking there for a swing low. The other thing to note is the 100 moving average. You can see which way it's going. Still in an uptrend, above the central pivot. And the other important thing is the Bollinger Band is above the 100 moving average as well. So everything's stacking on top. And this is one way to actually make a living. If you are looking to make $500 a day or whatever it might be, $5,000 a day, this is the way to do it. So let's grab our tools. We're going to go long just above this area here. I'm going to have a swing low of 30 pips. I can go for 2 times. Makes sense, doesn't it? But what I'm actually going to do is look at the swing low from the previous swing low. Grab my tool. from here. So you can take it from the bottom here, the extreme low, or from here. See how that works out. So let's take this one to this swing high here, drag it across so you can see it, and you can see that that's 50%, so you can go for 618% of 158.19, which gives you 67 pips, 2.24 risk to reward, as long as you've got 2 times, because there are going to be days where it doesn't work because markets are quiet or whatever. But if you follow the rules, and I mean the rules, then you have a system which works 90+% of the time. As long as you're not greedy, as long as your stop is in the right place on the swing low, then you'll do really, really well. So even if you're one lot, that's $670 there. And so that gives you a nice target to aim for. Let's have a look at a few other examples. So in this example of the US Swiss, this has been in a corrective mode for some time, since Monday the 22nd of January. So for a few weeks it's actually been going up, heading up to this area here. There's a supply zone here, which is a strong selling area, and back up to the 100-day moving average. But we can actually see the trend, can't we? So let's dial into the daily. And we can see that the daily is moving up. So above the 100 moving average, into liquidity, demand area, and now coming up to the supply area as previously mentioned. So is this a tradable event? Well, you could argue that the price has moved down above the 100 moving average. 4-hour chart. Again, you could argue that the price is now hitting demand area above the 100-day moving average, which is now pointing up into the demand area, buying opportunity here, buying opportunity back here, buying opportunity back here. And if we come into the 5-minute chart, there's an opportunity here as the weekly, the daily, the 4-hour say the price is going up based upon price action. And therefore the 5-minute might be a good idea if, for instance, the website says it's a strong buy on the US Swiss. If it doesn't, don't trade it. Make sure the rules are not broken. So we can say that the price is moving up. We have the trend clearly on the 5-minute pointing up. We have the price above the central pivot, which indicates further upside momentum is likely, and therefore we can calculate the break of structure. The break of structure is, I take it from the previous high. So we've had the swing low, which is what we need. We have to get that. That has to happen. So the price moves outside the Bollinger Band, comes into liquidity. There's convergence there, by the way, on liquidity as well. And therefore we can calculate, right, okay, this is getting ready for a move higher, much higher, potentially. And therefore the break of structure is that previous above that full candle there, let's say. So let's get our tools and put it just above the break of structure. Swing low, 24 pips, and you're going for 2 times minimum. You don't want any less, even if it takes longer to get to. There's your 49 pips. Now the intraday charts are fantastic because quite often we're not seeing it because of obviously FOMC and interest rate decisions and non-farm payroll this week. So, but nonetheless, the targets within intraday are way within the average true range. And the average true range for most currency pairs is between 60 and 80 pips, something like that. So if you're going for 50 pip target, one lot, $500, then of course, and it's 2 to 1, happy days. Now, the other thing we need to do, just to be sure that we're getting the right target, grab your tool, swing low at the bottom here, up to the previous high, and we can see that our target Should be slightly less, but I'm not. Well, you might be happy with 1.7. 1.7 is okay, but 2 times for me is what's necessary. And as we can see, the market is dead. Let's have a look at another one. So there's one here. So this is what you're looking for. You're looking for the price to retrace outside the Bollinger Band. Rule 1, you need to have a strong trend on the website. Coming into liquidity, above the central pivot. Again, practice. Have a look back, practice. Breaker structure here. Tools here. Along just above there. Swing low, 26 pips. Target 2 times. There. And so again, calculating your targets, grab the trend base fib to the top of the wick, drag it sideways, and then you can calculate your. Now the narrower the previous swing low, of course, the target's going to be much less. That's perfectly normal, but nonetheless I would personally go for 2 times. Now in this instance the 618 is here 1.22, so that's not going to be enough. So you may have to wait for a little while for that price to hit your target of 92.00. The other thing to talk about is round numbers. If you have a target of 9207, as this is, bring it down. 9200. The market loves round numbers and usually has a reaction on those numbers. So 00, 50, 80, 20 are important ones. Even it brings your target to slightly less than 2 times, but quite often 2 times during high liquidity markets is going to be easy to achieve. Hopefully you found that useful. I've gone on a bit, 27 minutes, but nonetheless I want you to be successful. So happy days.